The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, good afternoon, good evening to all of you out there. Thank you for joining this latest in the Bramasol series of webinars, number 10 for this year. Today we will be focusing on the most important thing, which is day 2 accounting. We're going to focus on, so you have complied with ASC 606. So now how can you automate revenue recognition? Joining me today is John Scott. He is a CPA, Senior Technical Accounting Advisor, and Carrie Peterson, a veteran of our webinar. So welcome back, Carrie, and she is a Senior Solution Engineer for our team. Let's get started. So as usual, we are recording this webinar. I encourage you to download it, go to the website, check it out. Ask questions throughout the seminar. We will be happy to answer any of your questions. Please focus on the if or whether I can do these things. If you ask more detailed questions, we do capture the questions and we'll follow up with you directly about more detailed things. And of course, at the end of the day, you can download our webinars from our homepage. Carrie? So download them. You can come here to bramasol.com, download those webinars. Up here, you can click on the Resource Center. It's a build slide. Go ahead. Or as you scroll down the page, you can find more information here, and we have all of our different webinars available. So again, I encourage you to go ahead and do that. Next slide. Contact us. Feel free to contact us. Come on down to bramasol.com, contact us. You can also schedule demos, and there are a number of ways for you to contact us. We're out on Facebook, and we are all in LinkedIn, and we have a number of groups running there, so feel free to reach out to us through those spaces. So today we're going to talk about something important. It's called Day 2 Accounting, and I'm going to have John run through the agenda in a moment. But why did we think this subject was important? At the end of the day, what we have found in the over 30 or 40 plus projects that we have worked on from a revenue accounting perspective, increasingly we have seen customers who have gone out and complied with 606 and IFRS 15. But complying is one thing. But the question becomes, what do you do on day 2 when you have things like contract modifications, variable consideration, changes to your standalone selling price and allocations? Do you have a solution that helps you automate that accounting, that is integrated to your financials and helps you achieve that? A lot of companies will go ahead and use spreadsheets for that purpose. And in talking with one customer that we recently started the project, what we learned is spreadsheets don't cut the mustard, as they say, or won't make it for you. And why is that? Well, a number of reasons. Number one is they introduce operational risk. A University of Hawaii study once recently found that more than 88% of spreadsheets contain errors. The errors can take different formats, whether it's formulae or missing data. And in Treasury, that can mean a lot of information is gathered, and in the case of revenue recognition, a lot of misreporting. They introduced this idea of key person risk. What do we mean by key person risk? Well, what happens if the person who built the spreadsheet moves on? Who's going to manage that? Spreadsheets waste time. We all know that it requires a lot of time to manage spreadsheets. I'm sure John just loved using spreadsheets in his role as an accountant. Spreadsheets lack security controls. Yep, okay, so you can lock different fields, you can lock them, you can put passwords on, but the reality is if you have multiple copies, they're not necessarily traceable. It's hard to manage user authentication, particularly when an employee leaves the company. Spreadsheets are easily portable. I can steal them, download them. I'm taking proprietary information. They don't support compliance. They're not equipped to handle true audit trails. So that's another issue. They don't support business continuity planning. If your PC goes down or where you're storing it goes down, there's no backup mechanism necessarily, so beware of that. That's all the reasons why we wanted to revisit this, because what we have found is many of our customers are looking for solutions that are integrated, scalable, and support all of these. So with that, I am going to turn it over to John and Carrie, and let's go right in. John?
Thanks, John. As John mentioned, I'm the other John, and we kind of picked a few critical areas that may be still done manually by corporations. We're in the second year for public companies. The private companies adopted this year. Kind of the three topics that require calculation and adjustments are contract modifications, variable consideration, standalone selling price and allocations. That's a multi-element arrangement. These are conducive to mechanization or optimization, as John mentioned, and we're going to kind of go through those and kind of go through the accounting a little bit to kind of refresh everybody's memory on these. What's the automation challenges and kind of our solution. Next slide. Kind of putting this in context, the SEC staffs had a year or so to look at public company filings, came up with a listing of comments that are critical to the user of the financial statements, and here's some of the comments they came up with. You'll notice variable consideration is the first one. There are comments there. How did you determine the transaction? Variable consideration, price. How did you even determine it was variable consideration? Your performance obligation, the nature of the obligation, whether it's a distinct good or service, and you'll notice how that comes into play on contract modifications a little bit later in this presentation. Kind of the disclosure, making sure your MD&A is consistent with your footnotes and any kind of press releases. That's a big thing for the SEC. And then recognizing revenue, the timing of when control transfers, your method of recognizing revenue over time, and accounting for any licensing agreements. These are kind of the critical areas they're kind of been focusing on. The SEC staff's always big on revenue comments, and these are kind of some I thought would put in context for what we're presenting. Next slide. Day two. Next. Okay, let's start with variable consideration. Kind of remind people what that is. It's caused by a host of different things. You can have discounts, refunds, credits, price concessions, incentives, performance penalties, etc. Makes the consideration you're about to receive variable. Now, once you kind of determine that it is variable consideration, there's two estimation paths. You either use the expected value or the most likely method. And what's the difference there? Expected value is more conducive to when you have a lot of contracts that have similar attributes. You group those together and then come up with a weighted average most likely amount you will receive. Whereas the most likely amount is just a single most likely amount. It's like a large contract. You either will receive that amount or not. I worked with a healthcare company. I'll give you an example on the expected value. Well, that's what we used. There's a lot of price concessions in the healthcare industry to patients. We grouped them by payer type and kind of calculated expected value. Now, the challenge here, as you'll see in the next slide, is these expected values have to be adjusted at each reporting period. So there's a recalculation going on there, and then you've got to decide whether or not you need to adjust your variable consideration at that point. That's the day two automation challenge. Next slide. As I said, variable consideration requires that at each reporting period, an entity shall update the estimated transaction price. So that's what you got to do. So how do you do that from an automation standpoint? Well, SAP RAR doesn't really have anything that's intuitive to handle variable consideration, but what we have Bramasol done is their workarounds. What you can do there is you kind of can tag those contracts that have variable consideration, so you know those need to be adjusted. And then what you would do is create two kind of obligations, if you will, for each contract, where you would record maybe the fixed portion and then the variable portion. I've got an example on the following slide that kind of walks you through that. Next slide. So, assume you had a $1,000 variable consideration amount, and you determined that, okay, It's going to be 800 and then 200. Well, that was estimated based on most likely amount. Now on day 2, you've re-estimated and you said, you know what, I'm going to get 850. So what do? You've got your 2 separate obligations that are linked to the right contract, and then you just merely adjust between those 2. You've got it tagged in the system. You go in there, do your calculation. You can adjust between those 2 split obligations. That's kind of the workaround. That's how you automate variable consideration.
Yeah, John, let me ask a couple of questions and clarify. I think when you say RAR doesn't do variable consideration, clearly it does that by using linked POBs and all of that. So let's, it's it does do that. There is a way to manage that. There are some workarounds for different areas, but maybe you can make that real. I know that you spend a lot of time in healthcare, and as does my wife, and one of the things that occurs to me as insurance companies are consistently and always negotiating for better prices. Would this be an example, or think of an example where, the Aetna comes back to your hospital and says, you know what, we agree that now the reasonable and customary charges based on X, Y, and Z are 100, are not 800, it's 850, or it's others. Did you see a lot of that, and is that something that people ought to be aware of?
Yeah, I'll give you a real tangible example. And we had to use spreadsheets because a normal pay cycle for a healthcare patient is about 5 years. And there's various type payers. You've got people on Medicare, Medicaid, you've got private insurance company, and then you've got self-pay. All of those have a kind of a patient portion remaining. Well, what we had to do is kind of group those all together by their respective attributes and kind of estimate what the expected value of what we were going to receive for those patient types of those contracts. And as you noted in the standard, you can kind of group those because they had similar attributes. Well, then maybe you see that they're paying at different rates, or you mentioned maybe the insurance company paid more than you thought. And so you've got to adjust that variable consideration. So that was an exercise, a big spreadsheet exercise, because you've got a lot of data there. Got to remember, it sounds like a simple concept, but when you're talking multiple contracts that have variable consideration, it becomes very much a tough spreadsheet effort that needs to be automated to, as you mentioned, to be A, not prone to calculation error, B, save you time, and C, make it more auditable.
Right.
So, if that kind of answers your question, then we go in and make that adjustment at each reporting period for the quarters and at year end.
Absolutely. Absolutely. Cool.
Next slide. Contract modifications. Now, modifications occur day 2. What happens is you either have a change in scope of your contract, price, or both. To be a separate contract, it has to have 2 attributes. One is that it's a distinct product or service that you've added. And the second is that it's priced at its standalone selling price. If it meets those 2 criteria, it's set up as a separate contract. If not, you're just adjusting your existing contract. Now, what does that mean? Well, that means you've got to do a couple things there. You've got to go through kind of based on facts and circumstances, is figure out if you need a catch-up entry, cumulative catch-up, and what you do on a go-forward basis to adjust for the revenue you're going to receive. Just as a throw-in here, talked about lessees and lessors and how they can modify and what you would treat that as. That's pretty straightforward. Now let me kind of give you an example on if it's a distinct product or service that you've modified, but you didn't do a standalone selling price. It's not selling at a standalone selling price. So say like you agreed to do 10 widgets at $10. You've delivered 5 of those. Well, now your customer comes back and says, I want another 5 more widgets, but you're willing to give those at $5. Well, you've obviously got a distinct product that you're delivering, but it's not at the standalone selling price. So how would you treat that? Well, what you would do is, since there's no cumulative catch-up, you would take the blended rate of the 10 yet to deliver, the 5 you haven't on the original, and the 5 new, and record those at a blended rate. Now, if you decide this fact and circumstance, it's not a distinct product or service. It's all part of a original contract delivery, but you've just expanded it. Meaning maybe it's a specialized product, you've added some more, now you're going to deliver some more.
Mm-hmm.
But still not distinct, but it's not at a standalone selling price. Now, how do you treat that modification? Well, what you would do there, that's when you come in and you'd have to calculate a cumulative catch-up adjustment based on the percentage of the contract you've already delivered, and then record the revenue on a go-forward basis at that remaining revenue to be recorded at that new price. That's how you handle the two, and that's the distinction. So basically, to walk through you again, there's 3 different paths, really. You either set it up as a new contract, there's a cumulative catch-up adjustment in some cases, or in both cases, there's a prospective adjustment going forward.
Yeah, that sounds that's great, and but and it sounds simplistic, and I'm sure people listening, oh, I can do that in a spreadsheet. But imagine that you have a multi-element arrangement with 15 or 20 different POBs in that arrangement, and some of them are time-based, some of them are event-based. Again, recalculating that and then ensuring that you've moved that from a spreadsheet to the GL in the proper way and made the proper journal entries. That can be complex, right?
Yeah, I mean, keep in mind all these, we're not talking about just one contract. These are hundreds. Some companies, it would be almost a huge exercise to track all these in spreadsheets, do the calculations, and then record all the entries. They're really ripe for optimization, and they need to be. And the bigger you get, the more complicated this becomes because just the vast number of contracts.
Right.
As I kind of mentioned on the previous slide, it's a modification occurs when you have a scope and or price adjustment or both. You either got a cumulative catch-up adjustment, a new contract, and you got prospective adjustments, and these all depend on the facts and circumstances. So you kind of got to analyze these on one-on-one basis to figure out what you got to do. As John kind of mentioned, here's the automation challenge. Contracts that have been modified need to have adjustments applied to them, and you're talking multiple contracts, and you got to be able to go in there and do the modification as well as track it. So that becomes a really tedious, hard exercise in spreadsheets, and the overall theme is the more you put in spreadsheets, the more prone to error, the more it's relying on maybe certain people staying with your company, or it's not able to transition from somebody leaving to somebody new, and the auditability becomes much more tough. Standalone selling price and allocations. As you know, in a multiple element arrangement, you've got to go find your distinct goods in that arrangement and then calculate a standalone selling price. Now, the standard will tell you that the best evidence of a standalone selling price calculation is observable market prices. Well, a lot of times that's not available, new product, what have you. So then it says, okay, if it's not directly observable, you've got to calculate that. And then they throw out some suitable methods for doing that. What are those methods? You've got your adjusted market assessment approach, expected cost plus margin, and in rare circumstances, they say use the residual approach. Now, most companies are going to do probably one or two things. They're going to either have a directly observable price, or they're going to go expected cost plus margin because they know what their costs are in most cases, and margin, et cetera, and that's how they're going to calculate that. Now, the standard also says you can use kind of a blended calculation using multiple of these methods. I've seen that in footnote disclosures. I've seen that with clients. So this becomes a really big exercise if you think about it. When you're a multi-element arrangement company, and a lot of those, you're sitting here doing all these calculations. You've got to weigh, how do I gather all the data I need to do these calculations? That's where the optimization really comes in, particularly on tracking prices for observable sales as well as costs on these products. You get a good report that generates it for you. You can calculate these pretty easily, because then what you do is you enter that price into RAR and do the associated allocations. Next slide. As I was saying before, how allocate based on relative standalone prices, determine the standalone selling price. You know, your best evidence is that observable price in a company's standalone sale, but a lot of time that's not available. So then you got to estimate it. So you've got to have a lot of good data there, because the standard's really telling you, you got to come up with a method that gives you the best estimate. And so usually, as I mentioned before, that's that cost plus margin is what I've seen in a lot of instances. And you don't need to update the standalone selling price after contract inception. Now, what's the J2 implications for this? What if you go in and you add additional products, services? You're obviously going to have to do this recalculation for those new additions at a standalone selling price and reallocate. Now, this slide that just popped up kind of shows you what it looks like in the RAR system. As you'll see, there's the standalone selling price, there's the allocated amount, and that's how it's working in the system. Next slide. And this kind of visually, I think I like visuals. This kind of gives you a visual representation. As you can see, the top part, observable price, always your best evidence. And that's the price at which entity would sell in open market. You know, that if you've got a lot of sales, that's a lot of data you got in your system. They got to have a way of pulling that out. If it's not available, estimate it. You can use a combination of these methods. Residual is really not used. It's saying in the standard, that's your least best method. I still say the cost plus margin is more realistic for companies, because they have that cost data, and there's got to be a way to gather that. That's where the optimization comes in. You know, some use adjusted market assessment approach. I think I read Microsoft's footnotes. They use a combination of kind of those two methods, was described in their footnotes. Next slide. So as I mentioned before, here's the day 2 challenge. The day 2, and even kind of day 1 really, is how you allocate the different standalone. That's a calculation. If you walk through the standard, you notice, say they give you these examples on how to allocate. It's a mathematical exercise. The calculation of the standalone selling price requires a lot of data in order to do that. And as I mentioned before, you have changes in these contracts. That's going to lead to maybe you've added new elements. You got to recalculate the standalone selling price. That's the challenge. Now, also at Bramasol, we've developed kind of custom reports that aids the clients in the calculation of the SP. How do we do that? Well, it provides you that data you need to estimate these, because you're going to input that standalone selling price once it's calculated. I like visuals. This is kind of a build out. Here you've got all your, your revenue documents, invoices, bills, all this data coming in. RAR does this, all these calculations and allocations and things of that nature, and it'll spit out your journal entries. The ultimate goal is to get you away from spreadsheets. Let's automate this. You've complied now. In order to optimize, you've got to automate. You're talking a lot of data. That's the complexity on the day 2 accounting challenges in these areas. Now, Carrie's going to kind of walk through. I mentioned that we've got kind of a demo that can show you how RAR can handle these various scenarios, and that's kind of what we're going to go through right now. Carrie?
All right. Thank you, John. So this is, and I'm using PowerPoint slides, screenshots instead of a live demo, just so we could do some more talking instead of really navigating through the solution. And the scenario is dealing with an airline. Thought that would be something that would probably hit home to anybody that's on the webinar, no matter what industry you're in, that you've probably all have flown on an airline. And probably have had a ticket change. So think about this not only from the consumer side, but then in the industry side of how they're managing not only the pricing of the tickets, which they don't recognize the revenue until the time of the flight. And then as changes happen, as you get or additional upgrades and that type of thing. But if you're, if you cancel a flight, if you change your flight, if they ask you to go standby on a different flight, all of those impact not only what you're paying, but then also, the revenue that they have to recognize that they have to track. So, and if you're looking down at just the ASC 606, there's specifically what John's been talking about, how the obligations have to be separated, what kind of a change is it? Is it a modification? Is it a new contract and such? So you can read that and go into that in more detail. But in this case, there was a passenger buys a ticket. They use part of it. They're going from Phoenix to Orlando. And then they're going to return from Orlando going through Charlotte on the way back. So there's actually 3 POBs or 3 obligations, 3 times that the airline can actually recognize the revenue when the passenger gets on the flight. So after the passenger flies to Orlando, they decide they want to fly to Charlotte 2 days sooner and then home to Phoenix. So there's a $200 change fee. And then there's additional cost of that, the change date, the change ticket. Okay, so in this scenario, we're using SAP's sales order to account for the 3 legs, you'd say, of the flight. Keep in mind that with RAR, in this case, it's coming from SAP in the sales order, but it can be a direct import from, if this was Sabre or if this was any kind of channel, Expedia out there, a different system. So it doesn't have to come through, again, an order or a contract within SAP to feed RAR. But we have our Phoenix to Orlando leg, which was $550. We had our Orlando to Charlotte, which was priced at $300, and then Charlotte to Phoenix. So this is the ticket price. In this scenario, we're not using a standalone selling price or an allocation. We're just modifying the price itself of the ticket. Okay. So when that order comes over into, and it's a transport, over into RAR, you can see that there are, again, here was the sales order. There was the 3 performance obligations, because again, in this case, they're separated for each leg. You're seeing the 550, the 300, and the 150. Again, we're not doing standalone selling price and allocation on this one. We'll just keep it simple. And then the event-based of this is, again, when the passenger, you're getting on the plane, they scan your boarding pass. That's the trigger then for the airline to recognize the revenue at that point. Okay. Going in further into RAR, into the contract. Oh, let me just back up one point. This was the, I don't know if those are familiar with it, this is the gap, and it also does dual reporting. So this could be if you IFRS as well or local. Okay. So here we're looking at the specific, and this was the local gap contract. And again, you have your 3 performance obligations. They have not been posted, has not been invoiced at this point, but it's unscheduled revenue of $1,000. Okay. And now we're going through, they went ahead and invoiced. So in this case, they're invoicing, because you do pay for the ticket, as you know, as soon as you buy that ticket, you pay for it. So there's the invoice portion of it. And at this point now, it's been invoiced and the passenger has flown from Phoenix to Orlando. And in that case, now you see that the recognized revenue is $550. The unrecognized revenue, which was the $300 for Orlando to Charlotte, and then Charlotte to Phoenix, has not been recognized yet, as they haven't been flown yet. So this is the point that the passenger is going to reticket their flight home. And in this case, again, we're going back into the sales order and we're doing an invoice correction. The time of doing invoice correction, it copies the original order and then into additional line items that are going to be adjusted. Since the passenger had already flown the first leg, that's why you're not seeing the Phoenix to Orlando leg there for the 550. On the invoice correction, again, I'm just using SAP sales order for this invoice for this. This information will be coming in from all different sources. The Orlando to Charlotte leg, the fee, so there was a fee on there of $200, and then there was additional $100 for that ticket change moving up that date. The Charlotte to Phoenix leg did not change. Okay. So then just seeing again the other nice, again, as you know, SAP, there's the document flow. So every document, every transaction that's happening between, in this case, the order and RAR, because you have the POB down here that are tied to the order, is being tracked in the document flow. So now that that change has happened, we go ahead and again, the import brings that data into RAR. You can see now the 550 that's already been recognized, the $600 for the second POB, and then the third for 150. Just jump one step further now. This, again, if you're doing this in Excel, you'd be tracking all of this information, data, but what we're seeing with RAR is it automatically goes ahead and makes the total revenue now available for $1,300, and then the $600, $150, and as soon as the passenger actually did the flight, then the revenue of $600, $150 would be recognized. So this was one, example of one ticket change, but you can imagine, for again the airline industry, the thousands of tickets that are being purchased every day, and then every modification that happens. And again, this one was not using standalone selling price, but there would probably be the option there of setting up the allocations based on selling price, and then also variable consideration. We didn't talk about breakage. So there are, let's say that that passenger did not return fly. They wanted them, come back 2 days earlier, but instead of flying on this airline, they just wanted to have that credit. They wanted to have a credit there, and they wanted to buy a ticket, a separate ticket or a different airline. Then that credit would stay live. Usually there's a year to use that. Well, there's a majority of passengers that never use that credit. So that variable consideration and that breakage of what is not going to be ever consumed, they have to take that into account. And then when that year was up, then they go ahead and recognize that revenue. So all kinds of moving pieces there. But this was just one simple example to show you how RAR would handle that contract modification change. So I think with that, I think we're going to be wrapping up a little earlier. John, do you have some questions out there?
No, I just want to remind people, I think on that last scenario you threw up, a partial termination of a contract or a cancellation is a contract modification. So that does require adjustments. And as you mentioned, and as you can see by this demo, when you're talking a lot of transactions and you're trying to do them in Excel spreadsheets, the ability to do that is more and more hard, and it's just ripe for error. That's why automation is really key in this area.
Yeah, and John, we'll talk about one thing, but even more complicated scenarios like this. And Carrie, thank you for bringing up the rebates. You reminded me to call American Airlines and get my rebate back. But also, those are interesting scenarios where you have partial tickets, partial return tickets. Also imagine like other companies, let's say like telcos, or service companies that provide more complex arrangements where you take advantage of some of the service, not some of the service. It's very important to have this ability to modify these contracts on an ongoing basis. Also, if you think of the airline industry, what if you have a combination of baggage fees, meals, and other elements that fit into this? Now you're allocating, not only are you allocating, quote unquote, across these different areas that have different value to them, but also think about the allocation to different business units. And John, I wanted to ask you a question as we look at this and think about what RAR does from a contract modification perspective, and variable consideration. In many cases, let's take the example of a high-tech company where different business units own different pieces. So you could have a piece of hardware, software, warranties, and a service plan all allocated to different business units. And so obviously, as you change the contract, modify that contract, you're going to be reallocating to different business units. But talk for a minute. One of the things I noticed in the SEC commentary of late is a key focus, and you are an auditor, so maybe you can talk a little bit about how you approach the key elements of disaggregation of revenue. We've seen that the SEC came down pretty hard back in 2018 on Google, Microsoft, and a few other companies saying, guys, we see what you've done here, but prove to us and show us, how you've done this disaggregation of revenue and why this idea of automation is so important to that process.
Yeah, I mean, here's the big thing for the SEC, et cetera. They want you to show that you've truly calculated correctly your best estimate of all these elements you're delivering. And why is that? Because it's going to be a tendency to people to say, well, geez, all my prices in my front end stuff. So I'm recognizing revenue way earlier because I'm overweighting my pricing to elements I'm delivering earlier rather than later. That's the biggest thing from an audit standpoint, is they want to make sure, A, you can support your calculations, and B, you're properly allocating it so it's recognized truly over time and not just front loaded, because that's what you can do through these allocation and pricing mechanisms. That's the big issue. Mm-hmm. And conversely with that, you bring up a good point, John, is when you start getting into the complexity of different big business segments and allocations of all these revenues at all these segments, you need something to bring that all together on an automated basis, because that truly is, you're auditing at a top level, and then you're working backwards to the significant data back in the segments. Conversely, you're also, if you throw in some foreign currency kind of implications, you really add a degree of complexity as well.
Absolutely. And I think of how many times I've traveled on an airline and it says, this flight is US Airways, but this flight is code share with XYZ. How does that work? And again, it's the allocation of that revenue that becomes so important. And if you're code sharing on an international flight and all of a sudden you're introducing foreign currency, again, that linkage to a core system, imagine trying to do that in spreadsheets, right?
Yeah, absolutely. Absolutely.
Hey, John, I'm gonna go back up to the slide that actually had the allocation. Just want to point out something else on here. So in this case, again, there was the contract price. So this would be on the order, hardware and the software. Again, the standalone selling price. The warranty was part of the hardware, and the support was part of the the software that didn't have a contract price. Those were built into the 10,000 and 5,500. But of course, there is, if you were just going to buy a warranty or just buy support, there is cost associated with that. So therefore, there is a standalone selling price. In this case, the 3,000 and 2,500. And then, just again, this is kind of a new functionality here for some people to see. What RAR has done is it took these standalone selling prices, totaled them, and then took a percentage of what the percentage 12.5 is to the total, and then applied that percentage, to 10,000, and or to the 1250 and the percentage to 3 and the 25 to come up with the allocated amount, and then again the percentage is there, so that if again, you just talk about modification. If somebody came in and said, well, I want to add another year of support, then that's modifying this, but it's based on the allocated amount here, and then it's going to be automated throughout. So just kind of wanted to give that. And one other thing that I just brought up was the fact that the warranty and the support, those aren't line items that the customer does see, but those are linked to, so the POBs, the performance obligations, are linked then to those line items, the hardware and the software. Right. So again, just kind of adding to some of the complexity over here on the fulfillment type, when the hardware was delivered, that was event-based, goods issue, and that's when the warranty started as well at the time. As far as the software, that was time-based. As soon as they invoiced, you download software right away, right? So that was time-based at the time of the order, and then the support started at that time because it's linked to the software.
Right. And in some of these cases, Carrie, you could have, a linked POB for forecast true-ups, which is variable consideration that has links to volume-based contracts, and you've created orders against those contracts. The contract has a set selling price at a specific volume and dollar amount for that volume, but if you achieve or don't achieve that number, you have to go through kind of a forecast true-up, and you would do that again, putting in variable consideration, but it goes to the concept of contract modification, right?
Mm-hmm.
Yeah. So one question that did come up, and it highlights the advantage of RAR, and maybe you can talk a little bit to it, Carrie, is, in the case of specifically in the case of airline tickets, we pay for those all in advance. And of course, we get a bill on our credit card, and the credit card pays the airline. Maybe we book them 2, 3, 4 months in advance. Does RAR, does this revenue recognition interfere with that collection of cash process, or how does that work?
No, it's completely separate. Mm-hmm. So again, the cash coming in is not the same as, again, the revenue that you can recognize during that period. So on the right now, I'm just going to show you on this allocated effect here, you see debits and credits. So, with RAR, and you can try to track this in Excel, there are subledger accounts that are going to be debited or credited based on when it is that, the cash comes in, but you can't, so, credit, cash, and debit, then recognize revenue, and then at the time that you can recognize the revenue, then you go ahead and allocate that then to reverse the entries. So totally different than actual cash coming in. Yep. Okay. Long short answer question there.
Absolutely. Yeah. Cool. All right, there are no more questions. Any more questions on the line? All right, so why don't we go to the end here, Carrie?
Yeah, let's go to the key takeaway slide and everybody get their final thoughts in.
Scroll back through here. All right.
Let me kick this off. So the key takeaways for me, and John will have his and Carrie as well, is RAR has some standard functionality built in there that'll help you handle these type of revenue kind of adjustments, your variable consideration, your contract modifications, your multi-element arrangements, your calculation of standalone selling price, as well as the allocation. And when you're talking thousands of transactions, you can see the importance on this. You don't want to be doing these in spreadsheets. Additionally, from a Bramasol standpoint, we've developed a couple other reports that'll help you do some of these calculations as well. I've known some companies that create kind of databases of costs and prices that help them do that standard selling price calculation. With us, we can help you automate that kind of feature. And overall, the importance is, as John would say, so what? Well, so what is the automation is key. You want to get away from spreadsheets because why? They're prone to error. They're not as auditable. They're time consuming. That's kind of the key for me. It reduces your workload, increases accuracy, and makes this a much more efficient process on a very complicated kind of topic.
Carrie?
Well, sorry, I was just listening to John there and agreeing with everything he said. So.
Sure. So I guess in wrapping up from my perspective, I think there's a couple of points that I'd like to hit on. Number one is clearly, for all of the reasons we discussed, RAR or a tool like RAR is a much better decision. And for anybody on SAP, because RAR is part of the core, it just makes a lot of sense for companies to take advantage of it. And we hear a lot about how complicated RAR is. And of course, in these sessions, we show you a lot of complicated scenarios. But the reality is, RAR is as complicated as your business process is. and we can help you simplify your revenue accounting processes. You can make them as complex or simple, and RAR is a tool that adjusts to that. For those companies that are looking to take advantage of a number of trends in the industry, the move towards SAP S/4HANA, RAR works and is part of the core S/4HANA product. So as you build your RAR rules and tools, they all work in S4. But we encourage you to standardize as much as possible, because what that allows you to do is take advantage of a number of things. Number one is the analytics that come with SAP. So you can use that. You can take advantage of the Bramasol analytics that we've developed, both for disclosure reportings as well as dashboarding. And finally, and you'll hear more about this in the future from us, is machine learning and robotic process automation. The truth is, RAR is a form of robotic process automation. What you're doing is taking information from an outside system, feeding it into a rules-based engine that then goes ahead and makes key decisions and allocates revenue accordingly. It is an automated, auditable, scalable, secure process, and therefore really feeds into the future vision of things like machine learning. Is it a machine learning-like tool? In a way it is. It gives you the opportunity to, through the RAI monitor and other tools, evaluate your RA contracts and your RA items, and evaluate which ones should post, don't post. If you like the postings, you can begin a learning process. And of course, that's the heart, if you will, of machine learning type technology. So really, if you think of the future, as SAP moves away from ECC to S4, as companies move to more and more automation, as we move to rules-based engines versus non-rules-based engine, RAR really fits that and helps support your day two accounting from the process of automating things like variable consideration, contract modification, et cetera. And as a final plug for Bramasol, having done dozens and dozens of these projects and worked with companies from hundreds of millions up to some of the largest companies in the world, we're experts in helping you figure out how to do that process. So, please enjoy and come to our other webinars. Reach out to us through the web. You can reach out to me or anybody on this thing. I want to take a moment to thank John for his great insights into his perspectives. Thank Carrie, as always, for a phenomenal job in sharing how RAR works. And then thank all of you for attending our webinar. I hope you have a great day, and I look forward to seeing you on our future webinars. We have two coming up in June, one focused on treasury and cash management, and will be by our expert team with over 20 some odd years of experience in treasury. And then we'll be talking again with SAP and Julio de la Costa about many of the new innovations coming up from a machine learning RPA perspective around treasury and cash and accounting. So again, thank you all. I hope you have a terrific day, and make it a great one. Bye-bye.